Hi everyone, this is Rohit Srivastava and I am the founder of Strike Money and Indiacharts, two very interesting platforms. If you don't know about it, download the Indiacharts app, try it out, and if you have not seen web.strike.money, that is going to be the go-to place for any research or analysis you're going to do on stocks, on the market, to find where the market is it topping out, is it bottoming out, and what stocks or sectors you need to buy. Complete vigilance in your hands. So do try it out. Comes with a 7-day free trial. Now, having introduced myself and the line of products that we offer, let's get down to the main thing: the markets. It's been a volatile series of sessions, and what comes at the end of it? I think we've seen a significant capitulation. Now, if you didn't hear my podcast, I do publish it on the Indiacharts channel on most podcasting, applications, whether it's SoundCloud, Apple Podcasts, Spotify, Google Podcasts, wherever. You just search for the Indiacharts channel and you'll find my podcast published there. So the most recent one, I covered a lot of ground on this recent volatility, but there are 2 points which came to my head which I didn't cover and I was hearing about. So I thought I should start with that, and that's what I'll do. The first one is related to the source of panic, right? One of them I've spoken about, and that is of course the yen carry trade. The yen carry trade is like this, that you raised rates, the yen was strengthening, and whatever mark-to-market losses were happening because of that, they've all been unwound in a matter of days, right? So that is why you saw the everything selling off situation on Friday and Monday. Now that has unwound. Now what is the next pressure point? The next pressure point which actually built up on Friday was the employment report from the US. Now, this employment report is being sounded out as a hoax by some people, and I'm using a strong word here. But the reason is that US data is very complicated, and when you drill down into it, you really understand what is going on. So, does this employment report showing rising unemployment really mean that people are being laid off? That is what a recessionary condition would be, and the answer appears to be a big no. And for 2 reasons. One is that to some extent there was a hurricane, and that means that some people in that particular month would have ended up showing as unemployed. But there's another very big reason why the overall data has been getting skewed recently, and that has to do with the immigration problem, right? The immigration problem is what Trump has been fighting all about, and in fact he was fighting about it even when he was in power, and he continues to speak on it. And because the number of immigrants that are coming into the United States, and they are of course jobless, when you recognize them as jobless, the unemployment rate ends up rising. So there's a lot of people who are being counted as unemployed, which is resulting in this spike. So there are 2 different reasons, whatever the case may be. But what they're really saying is that if you remove these numbers, then your employment market is actually not that bad. It might be strong still, So there's one more thing out of the window. Global markets are worried about it, but that's lesser the worry point. I think most of the selling did come because of the yen carry unwind, which is now behind us. So once the markets get a head around that and then they realize, well, US is still strong, then what's going to happen next, right? So you can't sell off this market based on recession fears. The other reason you can sell it off is, if rates are going to remain higher for longer. That's been the fear, and the Fed has been saying, no, we won't do it. So they've been using language as a policy, but keeping rates tight because they want things to slow down a little more than they already have, and quite some more maybe because they want inflation to really drop below 2%. Just like in India today, you had the RBI meet. The RBI is also not able to cut rates because inflation is coming down but remaining sticky in that 4 to 5% range, and their target is to bring it below 4%, right? So if you're not getting there, they're also backing off from cutting rates and then dealing with inflation all over again. So I think they'll get there because they're just keeping it high because growth is there, right? India is still looking at 7.2% growth. US just reported a GDP growth 1 week ago before all this turmoil of 2.8%, and we are looking at those kind of numbers. Then we're really not seeing recession. We are just seeing a mild slowdown, which can be seen in things like the ISM number, right? I've published the ISM chart. If you look at it, there are a couple of drawdowns on that data, and that's the ISM. For those who don't know, it's the PMI, basically Purchasing Managers Index. Readings above 50 mean growth, below 50 mean slowing, and it dropped to 46, 48, I think 48 this time, and it's dropped to 46 also before and reversed from there, and it came back on Monday. The data was 51. Okay, so that shows some reversion from a range where it is typically bottomed out in the past. during mid cycles. Now, what is a mid cycle? So you have extreme recessionary conditions like 2008 and 2020, and then in between that period, say between 2008 and 20, there were at least 3 occasions where the PMI fell to below 50 and then came back up and then fell below. So those are the internal cycles happening every few years versus the bigger cycle where you go into deep recession after 10-12 years. So we are in that interim cycle. We started to see things improve from 2020. 2022 things started to slow down. Markets have bounced back, rates have not come down, inflation is off, and that slowdown in the PMI is down below 50 again. So the point is that if this is a mid-cycle slowdown, very much related to the slowdown that started in 22, even though equity markets have recovered, if the PMI starts recovering from here, the equity markets are just been ahead of the economic data, which eventually then recovers and things get off from here. Given that I presume this is a mid-cycle event, this is not like an outsized financial crisis event where things slow down excessively and the PMI drops to 40 or something. So this is the situation. This was the first important data point to understand that if you're panicking around a US recession requirement, then that's really not certainly on the cards. Even though yield curve started to de-invert a little bit, we've seen that before, and then it went back into inversion again. So don't jump the gun. Watch and see whether the inversion really results in data changes or results in an equity bear market breaking the 20, 50 week averages and turn. Or in Elliott wave terms, what we do is we look for a 5-wave decline. There isn't a 5-wave decline, right? This decline is 3 waves on the Nasdaq, on the S&P, on the Dow, and therefore it is still looking like a corrective fall. A corrective fall is basically a correction inside a bull market, just a slightly bigger one. And now that it's happened and you've gone back to the 40-week average, why isn't it a good support from where things pick up again? So fears around US can easily be abated on this unless there's some other twist in the tail. And that takes me to the second point that I wanted to really bring up. So the second point really relates to the inflation and deflation cycle. I mentioned this in my podcast. I couldn't go into it in detail. I wanted to keep it under 30 minutes, so I just closed it. And then I realized that I mentioned I will talk about it, but I did not talk about it. And so let me talk about it here. And this has to do with the correlation between equities and bonds. Okay, we know that the equity market and the bond market have for many, many years been inversely correlated. But is that a permanent situation? And the answer is it's not. You have to be a student of the quantitative cycle, the economic cycle, which lasts for 70, 80, 90 years. It's really not a time cycle. It's a cycle of events. And it measures the entire bond market cycle at the largest degree, where interest rates go down a lot, go close to zero, then they go up a lot, they peak. And what happens during this phase, what drives these moves, are 4 different seasons that were really described by Nikolai Kondratev, the Russian economist who was assassinated, unfortunately, is what the story goes, because he wrote this theory and they thought he was a capitalist and they didn't like it. But the analysis itself is really about economic cycles, and it throws light on how it works, and it's a very great insight on the intercorrelation and changes in these correlations between equities, bonds, inflation, gold, and so on at different points in the cycle. So now, to really get into it, you have periods of inflation for 2 reasons. One is when you're inflating away debt. That was the 1940s in the US. Second is when you have an overheated economy. That was the 1970s to early 80s in the US, and in India it was the 1990s. And then you have a period where you have sustained growth, inflation is off, and interest rates keep coming down and bond yields keep falling for many, many years. And then you again get, at some point of time, excessive debt puts us into another, what we call an economic winter season. And then from there again, the choice is, are you going to default? And no, then you're going to inflate. And then you're back to the 40 situation where you're trying to inflate away. And so you get series of several rounds of inflation, deflation, and inflationary cycles, which try to bring the economy out of that dead period. That's somewhat where we are right now. And that means that you can have multiple cycles of inflation. But the important thing to understand here is this is a shift away from what was a deflationary period since 1980s, where inflation was really coming down for the US, and for India, where inflation peaked in the 1990s and has been coming down to a lower range. And what that does is that lower ranges allowed interest rates to really come off quite a bit. Now, after you have a financial crisis, you try to bring rates down even more significantly. That's already been done in the US. In India, we haven't seen rates, though we've had a financial crisis, NPA crisis in, post 2018. So I sense we are going somewhere there. The difference here, so basically, I mean, I'm going through a lot of theory, but the main point here is that when you're in a deflationary period and when you get recessions and you come out of recessions, the correlation between equities and bonds is pretty much inversely correlated, which means when equities fall because of a recession, bonds go up. So money moves out of equities into bonds, also known as the risk parity trade that people have put on, created funds around it, and has been going on for years. The second one is so the opposite of that, which is when equities reach the bottom and they start cutting rates. Bonds are still going up, and then eventually, as equities start going up, because the growth comes back, interest rates are raised again, and as they are raised and rates start going back to normal, you have a bond market that is falling. So you have a falling bond market and rising equity prices. Now this goes on till the point where it can work, and then you have a recession again because rates are too high or economy slowed down, and then again equities fall and bonds go up. So this is an inverse correlation which worked perfectly well in a deflationary environment, because you didn't have to raise rates due to inflation. You raised rates simply because economy was picking up and gaining steam, and then you thought it's overheated. There's a lot of borrowing, spending happening. Markets are getting expensive, and you didn't want it to overheat, and so you sort of raised rates. That's your deflationary environment. Now you're in an inflationary cycle, inflationary environment, where because you're trying to reduce debt, you have government spending coming in to keep growth on and reduce debt through inflation. That is like what happened in the 40s. Then every time you have an inflation problem because of the excessive spending by government or excessive monetary easing, that inflation calls for higher interest rates. So now when interest rate starts going up to curtail inflation, the stock market goes down, which means bonds and equities are falling together. Now it's no more that, bonds are rising because equities are falling because there's a recession. It's that, we have an inflation problem, we've got to raise rates and force a recession. Okay, so raising rates means bonds go down and equities follow because we are forcing a recession onto the market. That's what we saw in 2022-23. Now, after that, the market started to anticipate that, well, this inflation rate has fallen from 9, 7, 6, 5. Somewhere it will go back to normal, and therefore market started to recover because the bond market is also recovering. You see, as inflation data started to ease, the bond market started to rally in advance, even though the Fed has not cut rates yet. Typically, they should or would, but this time they've said, no, we won't be in a hurry. They could have done a little bit and left it just for courtesy's sake, but they decided, no, we'll be tough. So fine, they've been tougher, and having been tougher, they've kept rates at the same place, but the bond market is anticipating the Fed's commentary that is, yes, we are going to cut rates at some point of time. And so because inflation data is easing, the bond market is rallying, and stocks are rallying along with the bond market. Again, a positive correlation. Stocks and bonds are going up together. So we've seen both. We've seen stocks and bonds go down together. Now we are seeing stocks and bonds go up together. This is a change from what was happening before 2021-22. Okay, and this change is very important to recognize, because now if you go back and look at the previous theory that if bonds rally, stocks should fall, and that is when a recession will happen, that theory will get proven wrong. If you're making a prediction based on that, if you're making a prediction looking at the yield curve inversion and saying bonds will rally, stocks will fall, then you're going to get it all wrong. So it's not going to work that way. You're going to have to see it work slightly differently. So you'll have to go back and look at the 1940s cycle, look at the yield curve behavior. Then if you have data, I don't know if there's yield curve data for the 40s. The 10-year yield, you do have data all the way till that time period. But I don't think the 2-year yield has data all the way back to that time period, at least not on TradingView. And if you do have a data source with that, then yes, you can look at the yield curve. I've seen the yield curve through the 70s. There are a couple of inversions and recessions, but that's not the time period I'm referring to, right? I'm referring to the even earlier time period, which is all the way back to 40s. Now, of course, in the 70s also, you've seen the same thing, that when inflation peaked in 1980 and started to come down, bonds rallied and stocks rallied. So initially that was the relationship. Bonds and stocks were going up together. It's only much later in the cycle, as deflation started to take hold and inflation was not making a comeback, that these correlations shifted with the Y2K bubble and henceforth, because when the Y2K bubble got overheated, they started to raise rates. And that's the point at which we had this new market behavior, where raising rates was the cause of slowing down the economy and then resulting in a recession. And when that happened, they were cutting rates. So essentially, bonds rallied. People just moved out of equities into bonds. But that's not going to be the scenario now. Now it's going to be the opposite. Bonds and stocks rally together. So this is my theory based on the study of past and based on what I've seen. Because every time you've seen inflation cool off, whether it was 1980 or whether it was 1942 or all the subsequent periods, you've always seen equities go up at that point of time. And that is why I'm saying you are getting and you will continue to get a positive correlation on this point. Now, that doesn't mean that you've ruled out a recession and you will not get a steepening in the yield curve and a recession follow-up, all that stuff. But it might not happen as soon as you're thinking. It could get delayed. You could remain inverted for a longer period of time than you actually imagined. And that, because we saw that in the 70s also, multiple inversions, reversions in and out around that cycle while the inflation problem was still there. So when I see that, things can be different. We've seen the cycle play out pretty smoothly in the subsequent period. But before that, there was a lot of noise and reading through it would not have been that easy. So you will have to have a very different mindset to approach this and keep it in mind that correlations can change because the macro environment has changed and you can't look at it in the same lens. And so you may be waiting for a recession, but maybe it won't happen this year and it happens 2 years later. And then you get it, it's just too early and not worth taking that call because you miss out on all that can happen in the in-between. Similarly, right now, inflation is still coming down as the Fed keeps rates higher for longer. And if that inflation rate comes down, is it going to go up again? Of course. But is it going to take 3 years for inflation to go back to 4, 5, 6, 7%, where you have to raise rates again? Then that gives you that window of 3-4 years. So depending on the size of the window we can create for inflation coming back and for interest rates going down, the equity bull run can continue that much longer. And that's a very, very important insight to have in your mind, along with all the noise that is really out there. So we can easily get carried away by the recession narrative. But if you don't have a view on how inflation is going to play out, it's a long-term macro thing. It doesn't just rebound overnight. And how interest rates are going to play and why Fed is keeping rates higher for longer, because they don't want this thing to come back that fast, that early, at least not tomorrow morning. They want that time, they want that 2-year, 3-year time cycle and, period to be able to see this entire business cycle play out. So that is why it may play out in a very, very different way. And with that mindset is how I am really approaching the market. Yes, there can be corrections, there can be pullbacks, sometimes a little bigger than we want, but that may not really change the trajectory. That doesn't mean that the world is falling apart. So that's the second big takeaway to take based on this second part of the discussion. So 2 important points I've highlighted to you, both related to global macro and how they get your approach towards equity markets here in India, because we are impacted by that. And if you remove all of that, then a lot of the noise is gone. Then we're looking at 7.2% GDP growth in India with an upside bias, which means 7.2 can easily become 8 with some government work behind the scenes, which they are doing. They're actually trying to get this up to 8. But right now, the RBI today has projected the number still being at 7.2. But that I think sounds like the minimum base case. With upside bias, and if that upside bias kicks in, then growth can be much higher and markets can do much better than we are really thinking. So that's all from me on this update. I hope it makes you smarter about markets and be able to take good decisions. There's some very interesting setup we have right now on sentiment indicators. I've published a note. I would urge people to go to Indiacharts in the Indiacharts app and read it under the strategy section. Essentially, I call it the sentiment update report. If you go to the latest tab at the bottom, see the sentiment update. A couple of sentiment indicators from the Strike platform that have all, hit an important point, which allows us to take a view on markets in terms of where they should go from here. So I would urge you to go and take a look at that. And if you like to use the sentiment indicators, start with a 7-day free trial on the Strike platform. Sign up at web.strike.money. See you all there. I'm going to be doing a webinar this Sunday also on the Strike product, because we do webinars every weekend. Last weekend we had somebody do, a major advocate and user of the RRG in his own investment, and so he actually shared his insights with you. What I'm going to get into is RMI and the strike valuation setup. How do we look at long-term valuation indicators along with momentum cycles and make long-term investment decisions. So that's going to be very, very interesting webinar this Sunday. If you haven't heard about it before or understood the subject, or you want to learn how to use strike to look at historical valuation charts, then this is the event you really want to attend. So I'll see you all there. Yes, it's completely free. So you just need to join us, either on Zoom or on YouTube Live, one of the formats we usually take. You can just check it out on whatever platform you're on, whether you're watching us on YouTube or on Twitter. Just check the description, and we should have a link to the webinar for you to really join us. So see you all there on Sunday, and thank you.